Joining me right now is independent advisor, Alliance Chief Investment Officer, Chris Zaccarelli. Chris, great to see you. Thanks very much for being here. Are you expecting a hike in rates this morning?
Good morning. Thanks for having me back. Yes, we are expecting a hike in rates. We think they're going to raise rates on Wednesday, the 25 basis points that appears to be priced in. And then we think after that, they're going to take a pause in September, see how things go. So really the November meeting, November 1st, is what we're going to be looking to, which is quite a ways away from right now. And really, it'll depend on what the data says between now and then. If inflation stays persistently, stubbornly high, then I think the Fed will have a really, really tough decision. They may need to keep raising, but we could be seeing the last rate hike of the cycle tomorrow. And so that'll be really interesting for stock market investors. Clearly, a lot of people have been anticipating that because you see the returns of the market so far this year.
Well, there have been, that would be the 11th rate hike. What kind of an impact have you seen in terms of the macro story? And what are you hearing from management teams in their guidance in the middle of second quarter earnings reports this morning and all week? Are you expecting to see an impact of those rate hikes in terms of a slowdown?
Yeah, it's been very surprising. You would think with 500 basis points of rate increases, you would have seen more of a slowdown, and we really just haven't seen it. You know, you've seen the unemployment rate more or less stay pretty constant. You've seen consumer spending be very resilient, and so for now, corporate profits have hung in there pretty well for the most part. Clearly, the largest companies are the ones that have been benefiting, and they've had the highest profits. They're the ones to watch this week, those two big tech names that we're going to see today, as well as a few more tech names coming down the pike in the next 7 days. But for the most part, it really seems to be a mixed picture. Most management teams are still seeing strength within the consumer, and they're cautiously optimistic, whereas you are seeing some management teams express a little bit more caution and softness. But for the most part, things have held up a lot better than I think anyone would expect it about a year ago.
Chris, we're getting General Electric earnings right now. GE beats expectations with its revenue at $15.9 billion in revenue and earnings of 68 cents a share versus the estimate of 46 cents a share. Better than expected, both on revenue and earnings. The stock has done well over the last year. What do you want to do in terms of allocating capital here with regard to what you're hearing from earnings?
Yeah, so what we've seen from earnings so far, and again, it's very early into the earnings season, but we would continue to deploy capital across the market. We'd be investing in the market, dollar cost averaging. Specifically, we're looking within the financials and industrial sectors, of which GE is within the industrial sector. So in general, yes, we're looking within those sectors that have been left behind a little bit by this market rally. And if there is a cyclical recovery still underway, if the recession truly is pushed off for another 6, 12 months or even longer, then getting into those cyclical sectors like industrials, like financials, makes sense. There's still a lot of room to run within those companies' profits, and we're seeing that today, as well as in their stock prices, which really haven't kept up with tech, consumer discretionary, and communication services so far this year.
Well, we're in the middle of a very busy week. Carol Roth, jump in as we await the Fed decision tomorrow, and all of these earnings hitting pretty fast this morning.
Yes, I'm wondering if you think that the Fed is perhaps, a little bit behind the 8 ball and the market's too optimistic here, Chris, given the fact that they have been focused so much on the demand side. And on the supply side, we know that they can't print oil and they can't print food and they can't print housing. Do you think that we're going to see this kind of long-term stickiness to inflation that the market perhaps isn't pricing in right now?
We do think that. We think, you've seen goods inflation come up and come back down, and you've seen services inflation peak and then start to subside. But we do think there's going to be some stickiness, exactly to your point, within the services side of inflation. There's a lot of components to the economy that are interest rate sensitive, but clearly lots of the economy is not interest rate sensitive or not as sensitive as we would have thought. And so, you're seeing that you're seeing the inflation rate come back down. And so from 9% to 4%, it's come down in a relatively straight line. Whether we can go from 4% to 2%, that's the real question. And I think that's what the Fed is wrestling with. And you're seeing the hawks and the doves really having that argument. I think there are a lot of people who say the Fed's done enough, inflation has come back down. And there's others who say, yes, it's come down a lot. But in order to get back down to target, that 2%, which still seems pretty far away, it's going to require a lot more effort. And so I think only time will tell. Really, I think it's anyone's guess, how much more interest rate hikes would be needed in order to get us back down to that target. That's the big debate right now.
Yeah, and to be clear, we've seen an impact on certain, of course, interest rate sensitive groups like housing, like autos. We've got a big week of economic data coming up on housing as well. We've got the May Case-Shiller 20-city home price index out at 9 a.m. Eastern today. We've also got the first read of second quarter GDP coming out later this week, and June durable goods out on Thursday, followed by the June PCE report out on Friday. Chris, what are you watching most closely here? Is it some of this data coming out, or interest rate sensitive groups, or earnings?
We're looking most closely at earnings. You know, it had been the Fed that was driving everything last year, clearly with that big sell-off in the stock market. And I think for most of this year, people were looking to see how far the Fed was going to go. But at this point, given how strong consumers have been, how resilient corporate profits have been, it's really got to be all about earnings at this point. You know, if we had the unemployment rate going a little bit higher, that's probably the only macro data that I'd be looking at really closely right now. But given all of the information that's coming out, all the macro data, all the micro data, for us, earnings are the most important because we want to see how are companies doing, and more importantly, what are they forecasting for the rest of the year? It's really that forward outlook that's most important to us.
Sure. Chris, good to see you this morning. Thanks very much.
Thank you.